Hello everyone, and welcome back to this crucial market update. I need you to stop everything you are doing and pay very close attention to what I am about to explain, because the events that have transpired over the last 24 hours are not just standard market fluctuations. We are not looking at a simple technical correction, nor are we witnessing a healthy bout of profit-taking by traders who have had a good week. What we have just witnessed is a calculated structural intervention in the silver market. It is a phenomenon that goes by many names in the financial world, but in plain English, it is a rug pull. The rules of the game were rewritten in real time, exactly at the moment when the price of silver was threatening to break through a critical resistance level that had the entire paper banking system sweating. Let us set the scene so you understand the gravity of this situation. Silver prices were surging. We were seeing a push through the mid-80s in terms of relative strength and price targets, a level that many analysts had marked as the point of no return for the short sellers. The global spread, the difference between the price of physical silver and the paper contracts traded on the exchanges, was blowing out. The market was signaling that the metal was undervalued and that a massive repricing event was imminent. And then quietly, clinically, and without any public debate, the exchange hit the one lever they have left to stop a runaway train. They raised the margin requirements. They forced small traders and speculators to dump their positions whether they wanted to or not. Now, before we dive into the specific mechanics of how this financial violence was inflicted, I want to ask you a philosophical question that cuts to the core of this issue. When a casino changes the table limits in the middle of a hand or in the middle of a winning streak, who is that change meant to protect? Is it meant to protect the players who are finally seeing a return on their risk? Or is it meant to protect the house, the entity that cannot afford to lose? Because what happened overnight was the futures house raising the cost to sit at the table. They did not announce that this change would happen next month to give people time to prepare. They did not put it up for a vote among the members. They implemented it immediately, right when the market was heating up and the momentum was undeniable. The timing is the ultimate tell. If this were about safety or orderly markets, it would be done during a lull, but it was done during a breakout. Here is the sequence of events in plain English for those who do not stare at charts all day. Silver ran hard. It began to climb vertically. Futures traders, seeing the breakout, piled in to capture the move. Leverage, which is the fuel of the futures market, did exactly what leverage is designed to do. It amplified the move on the way up and attracted even more participants who wanted exposure to the rally. Meanwhile, the physical market remained incredibly tight. Premiums on coins and bars stayed sticky and high, and overseas prices in markets like Shanghai signaled that the real metal was worth significantly more than the paper quote in New York or London. And then the exchange that governs the main paper venue issued a margin advisory. In effect, this advisory said that if you want to hold the same position today that you held yesterday, you now need significantly more cash in your account immediately. That one simple rule change creates forced selling. It does not matter if the fundamentals of silver are better than they have ever been. It does not matter if industrial demand is skyrocketing, because futures trading is not like buying coins and sticking them in a safe where you can hold them forever regardless of the price action. Futures trading is a balance sheet game. It is a game of liquidity. If your account does not meet the new cash requirement, you do not get to debate the fairness of the rule with your broker. You do not get to wait for a bounce in the price. You have two choices. You either wire in thousands of dollars in more money instantly, or your broker closes you out at the market price, regardless of your loss. That is how liquidation is manufactured. That is how a crash is engineered. We need to move beyond the emotion of this event and break down the cold, hard mathematics of it. Because this is where the manipulation stops sounding like a conspiracy theory and starts sounding like a mechanical certainty. To understand why this margin hike was so devastating, you have to understand the structure of a silver futures contract. One standard silver futures contract on the COMEX represents 5,000 ounces of silver. If silver is trading around a hypothetical or target level of $85 or even $50, the notional value of that contract is massive. At $85, that contract controls about $425,000 worth of silver. Now, when you trade futures, you are not paying that full $425,000 up front. You are posting margin. Margin is a performance bond. It is collateral that you deposit with the exchange to say that you can cover any adverse moves in the price. Under the old framework, before this sudden change, the margin requirement was a fixed dollar amount, often hovering around the low $30,000 range per contract. This is the power of leverage. You could control nearly $500,000 of silver with just over $30,000 cash. That is a massive amount of exposure for a relatively small down payment. However, the exchange has the unilateral right to change that requirement. Imagine they swap that fixed requirement for a percentage-based requirement, or simply hike the fixed rate significantly. Let us assume the new requirement effectively jumps to roughly 9% of the notional value. If we use our example of a contract worth $425,000, 9% of that is roughly $38,250. That is an overnight increase of roughly $5,700 per contract. You might sit there and think, well, $5,000 isn't the end of the world for a trader, but you have to multiply that pain across the entire market. If you are a trader holding 10 contracts, you are suddenly short $57,000. If you are a mid-sized fund holding 100 contracts, you are suddenly scrambling for over $500,000 in cash that you were not told you would need. And you have to come up with this money immediately. This scramble for cash does not happen in a vacuum. It happens across thousands of accounts simultaneously. When thousands of accounts are forced to reduce exposure at the same time because they cannot wire in the new margin funds, it creates a self-feeding dump. People sell their positions to meet the new requirement or are liquidated by their brokers. This selling pressure pushes the price down. The falling price then reduces the equity in everyone else's accounts, which triggers more risk controls, more margin calls, and more forced selling. It is a cascading waterfall. On a price chart, it looks like the rally failed naturally. It looks like the market rejected the higher price. But the rally did not fail. The exchange slammed the brakes. I am being dramatic about this because it targets a specific category of trader. This mechanism does not hurt the massive bullion banks. Big institutions can post more collateral in minutes. They have balance sheets in the trillions. Market makers can shuffle capital effortlessly. Banks can rehypothecate assets and borrow against everything that isn't nailed down. But the smaller participant, the retail trader, the family office, the person who used futures for exposure because they do not have 7 figures sitting idle in a checking account, they get squeezed out by design. If you have been around the silver market long enough, you have seen this movie before. It is a script that is replayed every time the price threatens the solvency of the shorts. The price climbs, the narrative turns euphoric, the crowd gets involved, and then margins mysteriously rise. Not once, not twice, but sometimes repeatedly in quick succession, until the leverage side is completely flushed out. Then, the same institutions that survived the margin squeeze because of their deep pockets get to buy into the weakness. They cover their short positions at lower prices. They go long at the bottom, and they reset the game for the next cycle. What should make you furious is how this is presented to the public. Raising margins is always presented as risk management. The exchange will issue a statement saying they are ensuring market stability and protecting against volatility. It sounds neutral. It sounds responsible. But the effect is not neutral. It selectively punishes the side of the trade that relies on leverage, which is almost always the speculative long side. If the market is crowded with people betting on the price going up, raising margins crushes those people. The exchange cannot pretend it does not understand this dynamic. They know exactly which side gets hit, because they see the positioning data. They know who is long, they know who is short, and they know exactly where the pain point is. This tells us that the paper venue is incredibly sensitive right now. It tells us there is a genuine fear of a disorderly move to the upside, And it tells us that someone with influence prefers a controlled retreat over an uncontrolled breakout. They would rather crash the price temporarily than risk the price finding its true equilibrium, which might be significantly higher than where we are today. Now that we understand the mechanics of the manipulation, I want to connect this to what you are likely thinking and feeling as you watch the price wobble on your screen. The natural reaction is fear. You see the red candles, you see the headlines, and you ask yourself, does this mean the move is over? Was I wrong about silver? That question is exactly what the system wants you to ask. It is the intended psychological outcome of the margin hike. If they can turn a rule change into a psychological narrative of failure, they can get you to voluntarily do the thing they want, which is to sell your position, without them having to take the blame for forcing you. We must separate the signal from the noise. The paper market can be jolted by margin policy. It can be manipulated by high-frequency trading and rule changes. But the physical market is governed by different laws. It is governed by supply, demand, and the willingness of holders to part with their metal. If real demand is strong, if global inventories are tight, if premiums stay elevated, and if overseas prices remain above domestic quotes, then a paper-driven dip is not a thesis breaker. It is a transfer mechanism. It shifts metal exposure from weak hands, those playing with leverage on the casino table, to strong hands, those buying physical metal or fully funded positions to hold for the long term. Yes, this might mean volatility. It might mean ugly candles on the daily chart. It might mean a couple of days where everyone suddenly becomes a technical analyst and tells you that support is broken at some magical number. But remember, forced selling is not informed selling. Forced selling is mechanics. It is a liquidation engine running its course. It does not mean that the industrial need for silver and solar panels has disappeared. It does not mean that the monetary demand for silver as a hedge against inflation has vanished. Let's talk about the overseas spreads, because this is where things get truly spicy and where the bullish case finds its strongest validation. When you see a meaningful premium in a major foreign exchange or futures venue, like the Shanghai Gold Exchange, when silver trades noticeably higher elsewhere than it does on the COMEX or in London, that is the market screaming that metal is valued differently depending on where you are. In a perfectly efficient market, arbitrageurs would close that gap instantly. They would buy the cheap silver in London and sell it in Shanghai. The fact that this gap persists tells us that there is stress in the plumbing. It tells us that physical metal is not moving freely enough to close the gap. When stress shows up in the plumbing, the paper system's job is to keep the headline price from running away. This is why margin changes are so powerful. They do not have to manufacture silver. They do not have to create new supply from a mine. They simply alter the cost of holding paper exposure so that the most price-sensitive participants are ejected. And once those participants are gone, the remaining market is easier to manage. This does not mean silver cannot dip further. It absolutely can. In fact, dips are the whole point of the tactic. But a dip caused by margin pressure is fundamentally different from a dip caused by collapsing demand or abundant supply. One is a paper event, the other is a real economy event. Here is the cliffhanger you need to sit with. If they had to pull this lever now, what do they think happens if they don't? Because nobody raises the table stakes in the middle of a hot run unless they are worried about what the run becomes next. If the concern was truly just generic volatility, why is the rule change happening right after a breakout level? Why is it happening when retail participation is elevated? Why is it happening when the narrative is undeniably bullish? If this were purely about risk, you would see predictable, gradual adjustments, not a surprise punch to the stomach designed to maximize liquidation. We must also look at the bigger macro backdrop that makes this margin move even more revealing. There is a reason hard assets keep grabbing attention. The global debt load is massive and mathematically unpayable. The cost of money is unstable. Policymakers have a habit of choosing liquidity over pain. When the system strains, the reflex is to add liquidity, to print money, to bail out the system. And when liquidity floods in, it doesn't land evenly. it tends to lift scarce real assets, especially the ones tied to industrial need. Silver is uniquely tricky for the controllers. It is not just a monetary metal people hoard in safes. It is also an essential industrial input. It sits inside electronics, energy infrastructure, missiles, satellites, and high-tech manufacturing. You can shout speculation all day, but factories still need ounces to operate. And when the industrial side collides with investment demand, the paper supply promises start to look optimistic at best and fraudulent at worst. So imagine this scenario. You have a market where the paper price is pushed down by forced liquidation via margin hikes, while the physical market stays tight and premiums don't collapse. What happens next? Either the physical market loosens, meaning supply suddenly appears and premiums drop, or the paper price eventually has to chase the physical reality. That is the fork in the road we are facing. So, what is the actionable strategy here? How do you navigate a market that is clearly rigged against the leverage player? The first step is to recognize the arena you're stepping into. If you are holding physical silver, coins, bars, allocated storage, this margin stunt cannot touch your metal. The exchange cannot force you to sell your silver eagle coins sitting in your home safe. They can only touch paper positioning. However, they can influence the headline price, which influences your emotion, which influences your temptation to sell. And that is the trap. The trap is believing the paper quote is the full truth. If you are trading futures, the game is harsher. You are playing inside their arena, under their rules, with their ability to change those rules at a moment's notice. If you get a margin call, you are not being asked if your thesis changed. You are being asked if you can post cash. That is why so many people eventually conclude that futures is a place to trade for short-term gains, not a place to build long-term conviction or generational wealth. If you do not own any silver yet, this moment poses a critical question. Are you waiting for confirmation from the very system that benefits from you being late? Because the best moments in hard asset cycles often feel uncomfortable. The best entries rarely happen when everything feels safe and the chart is pointing straight up. They happen when the crowd is panicking and the weak hands are folding. Here is your battle plan. First, watch the overseas premium. Does it widen again after the paper shakeout? If the price drops on the COMEX but stays high in Shanghai, the arbitrage is screaming that the drop is fake. Second, watch the retail dealers. Do they stay sold out? Do premiums drop, or do they remain high despite the lower spot price? If spot price drops, but the price to buy a physical coin stays the same, that is the dealer telling you the paper price is irrelevant. Third, watch delivery demand. Are big players still standing for delivery of physical bars? I also have two questions I want you to consider deeply. First, do you think raising margin requirements during a breakout is legitimate risk management, or is it targeted damage control to save the shorts? Second, if we get another sharp dip purely from paper mechanics, are you personally a buyer, a holder, or are you stepping aside? Your answer to that defines your success in this market. People feel betrayed when a market is run this way. They feel like the game is unwinnable. And that is exactly the feeling the system loves, because discouraged people stop participating. They go back to passive indexes, back to yielding less than inflation, back to trusting that the rules will stay the same. But in hard asset cycles, the rules do not stay the same. The rules change because the system is defending itself, and that is why I keep coming back to physical ownership. If your goal is to trade, fine. Understand the risks. But if your goal is to protect purchasing power, then the more paper your exposure is, the more permission you need from the same system you are trying to hedge against. One final thought to leave you with. If this is the first margin shift in this move, what happens if silver pushes higher again? Historically, the lever can be pulled more than once. The question is whether they can pull it enough times to break momentum without breaking confidence in the venue itself. Because if participants begin to believe the venue is hostile, liquidity can migrate. And when liquidity migrates, control weakens. My bottom line is this. The margin hike is not proof the bull move is dead. It is evidence the move matters. It is evidence the breakout threatens someone powerful. It is evidence the paper market is choosing enforcement over acceptance. And in my experience, that is usually a sign you are closer to the truth than the headlines want you to be. If you found value in this breakdown, the simplest action you can take is to subscribe to this channel. It is short, effective, and it helps you stay plugged in when the next emergency headline drops. And if you want to help this message reach people who still think markets are always fair, share this content with one person who needs to see how the lever works. We are going to watch the next sessions closely. We are going to watch whether the dip is bought, whether the spread returns, and whether the physical market shrugs off the paper tantrum. Because the real story isn't the candle. The real story is why the candle had to be forced in the first place. Stay calm, stay liquid, and keep your eyes on the premiums. Do not let a red candle bully you. Do not let a policy memo rewrite your conviction overnight. Watch what happens the moment price tries to reclaim the highs again. That reaction will tell you more than any chart ever could. I will see you in the next update.